What are the tax implications of joint ownership and a cohabitation agreement, and how can these implications be managed and minimized?
Lawyers love to say two things. It depends, and talk to
Mm-hmm.
your accountant.
Mm-hmm.
I'm not a CPA, and so I can't give you detailed tax advice, but I can tell you that there are certain real estate specific tax implications that are important to know about. Um, the first one is for a joint ownership agreement. The homestead cap exemption, or the homestead cap, or the homestead exemption, because they're two different things, only applies if it's your primary residence, and you have to own it for it to be your primary residence. Meaning, if you and I own a property together, well, the fact I have 50% and you have 50% still allows for the full homestead protection and the full homestead cap for property tax values. And what I'm talking about there, just so that everyone knows, is in Texas, if your property is worth $1 million and next year the valuation goes to $1.2 million, if it is your homestead, the value that you're taxed at, not the market value, but the taxable value, is capped at 10% growth per year. And so even though it went from a million to $1.2 million, you don't pay taxes on 1.2. You only pay taxes on a million plus 10%, $1.1 million. If, on the other hand, I own 50% and you own 50%, but you have your own separate homestead, and so this is not claimed as a homestead, well, then I can only get a 10% cap on the 50% that I own. And so that means that I would have to pay taxes on 1.15 million because I only get half of the cap applied to it. So $50,000. And so when you have that joint ownership agreement, you need to make sure that you're either dealing with percentages that make sense, homestead issues that make sense, all of that is what you need to have happen. A secondary issue that I had someone bring up that I thought was very smart was someone had bought a house. They were doing it with a friend. The friend had some money they wanted to invest into the Austin market. They wanted to get into a home. And the requirement that the person that was going to be living there had, in addition to some other things that were very responsible, but they were needing this money, was, look, you can't make me sell this for 2 years. There's a lockup period. And the reason for that is there's a capital gains tax exemption.
Mm-hmm.
If you live in a property for 2 years, you don't get taxed on as a single person the first $250,000 of profit of that house. And so those are some other considerations that people take into effect when they're putting these joint ownership and cohabitation agreements together. But as far as taxing goes, the homestead exemptions are really the most important things that you'll have, with the capital gains exemption kind of following up on that. But those tend to be difficult to do end arounds for, or to address and I don't want to say manipulate, but minimized. You can only do so much. Real estate's fairly objective in ownership structure. So there's ways you can curtail it a little bit on the joint ownership, mom, dad ownership, but not much more than that, I'm afraid.
I would say that'd be especially more important just because we live in Austin and the type of real estate here.
It's very important. We don't pay sales tax because we pay a whole bunch in property tax, but
Hmm.
that doesn't mean that you should give up whatever reductions you can get.